Hello, everyone. Welcome to today's edition of The Final Bar. It's great to be back live with you. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. It's a pleasure to be with you most weekdays after the close. We took quite a break here for my trip to Mumbai, and it was such a pleasure to meet many of you in India in person, a number of you who have watched the show for a number of years. So such a pleasure to meet you in person. Great to be back with all of you live here from our home office in Redmond, Washington. Quite the distribution day today in the markets. We're going to get to the charts here in a few moments. I did want to let you know about the schedule coming up this week because it's going to be an interesting sort of adjustment week here. No guests this week. We're going to do our regular show, just me. And then next week, we have three really good guests lined up for you. On Tuesday, the 15th, we have Larry Tentarelli of Blue Chip Daily. On Wednesday, Ryan Dietrich of the Carson Group will be joining us on the show. And then Julius de Kempener on Thursday, November 17th, founder and creator of the RRG research platform, will be joining us from Amsterdam. Let's continue on today's show with our market recap. All of the charts that we use, you are welcome to, as always. They're all featured on the StockCharts platform. We'll pepper in some ACP charts as well as time goes on. But let's get to the markets today. S&P finishing the day in a position of weakness, just below 3750. That's down 2.1% from Tuesday's close. And Tuesday, we didn't have a show, sort of a choppy sideways session. Today opened low and then just kind of accelerated to the downside from there. A lot of this is due to events in the crypto space. We'll get to the charts of cryptocurrencies here in a few moments. But I do want to let you know, in terms of this general risk-off move, not surprising to see the NASDAQ outperform to the downside. So I guess that's underperformed, but the NASDAQ down 2.5% today as well. Mids and smalls all down over 2% as well. The VIX creeping back higher, now back above 26. We talked about how the VIX had been above 30 for quite some time. Breaking back below 30 was a potential sign of a bottoming pattern. Now we're seeing volatility increase again as uncertainty starts to or builds, I guess, in the markets. We'll hopefully get to a chart of the VIX here in a minute as well. Kind of a choppy session if you're looking at interest rates. 10-year yield finishing the day around 4.15, 30-year yield just above 4.3%. 5-year yield is just below 4.3%. So we still have a bit of an inverted yield curve. And again, one of my main, the chart that I suggested was the number one chart to pay attention to, besides just the S&P, was 10-year yield, the $ TNX. I think that has played out incredibly well on days and over time when rates have been moving to the upside, when bonds have been in a downtrend. Defensive areas of the market, certainly more value-oriented areas of the market, have done very, very well. And you're certainly seeing that play out today. The dollar index pushing to the upside. The UUP was up 0.75%. That's a bullish dollar ETF that we track. So this was one of those strong dollar, weak everything else type of days. On that note, commodities all mostly in the red, with the GLD down 0.5%. The silver ETF that we track down 1.7%. Oil prices down in a big way, and the energy sector got hit pretty hard today. The main driver, arguably, for a lot of this distribution, two things: earnings, and we're going to have a segment a little later today called The Bottom Line, where we focus on some of the recent earnings reports from some of the major stocks out there and look at some of the numbers that we've seen this week from a technical perspective. The other big thing is obviously the news from Binance and FTX, sort of crypto exchanges going through quite a bit of a challenging week. And the price of Bitcoin, the price of Ethereum, and literally all the other major cryptocurrencies that we track, essentially in a free fall. Now, it's so funny to me. If you told me 10 years ago that we would be saying weakness in cryptocurrencies is driving down stock prices, I would have laughed you out of the conversation probably. I can now because it's a legitimate issue, right? If you're a big investor and you own a lot of cryptocurrencies, and you're getting hit with a margin call because they've accelerated downwards so quickly in the compressed time period, and you have to sell other stuff to be able to cover your margin calls. You're probably selling stocks that you owned. That's arguably one of the contributing factors to equities being so weak today. Now, it's worth noting that even on a day like this, when all 11 S&P sectors are lower, there are still plenty of names in the S&P 500 that are having pretty decent days today, right? Home builders, DHI is one of the earnings names this week, up 3% today. And again, it's not the world's most perfect chart, but it's certainly in a position of strength, while the average or the growth stock, right? The average equity we might look at is more in a position of weakness. So it's worth remembering that even in a down day, even in a down stretch, there will be bright spots out there. It's up to you to sort of identify those and look for some opportunities there. We're going to get to some charts of, actually, let's look at some macro charts here. We'll come back and talk about the sectors here in a minute. When I'm looking at my daily chart of the S&P 500, again, I was in India for the last week, still watching the equity market, still writing some content for my premium members at Market Misbehavior, but not doing the shows. I had a little less moment to moment, and I was sleeping through the U.S. trading session, to be honest with you, adjusting to the time difference. But looking with fresh eyes yesterday and today, I'm struck by what I would argue, if you take a couple steps back from your monitor, I know there's a lot of bullishness that has come out in the last month. I don't see it, right? From a medium-term, long-term perspective, this is very much a market in a downtrend. And I would quantify that by looking at the highs and the lows. And I would say overall, you're seeing lower lows and you're seeing lower highs. That is the general channel. That is the general trend in the market for 2022. So if you would draw a regression analysis from January 1st to today, I've not drawn it on here, but if I did, I would say we're probably right about in the middle of that, right? If you think of the upper end of this channel as this trend line, you can kind of draw a loose trend line on the lows there. We're kind of at a midpoint of this downtrend, but we're still very much in a downtrend. We have two downward sloping moving averages, and we're below both of them right now. On the most recent rally, where the S&P retraced at about 50% of the sell-off from August to October, right? We made about 50% of the way back, just above 3,900. Now rolling back over, we're back below the 38.2% line. On that rally into the peak there at the end of October, the RSI did not get above 60. And if you've read any analysis by Connie Brown or Andy Cardwell, to talk about basically a range technique with RSI, Connie's book, Technical Analysis for the Trading Professional, I think articulated this idea very well. It's a formative book for me when I was in the CMT program a number of years ago, was looking at where the RSI and other oscillators, what levels they hit, right? And in a downtrend, the entire range goes down a little bit. In a bullish trend, the entire range goes up a little bit. So when you see a rally, a short-term rally, below the 200-day moving average that is sloping downwards. And on that rally, when we get to the end of that rally, the perceived end of the rally, and the RSI fails to get above 60, this is more characteristic of a bear market phase, right? This is what bear markets kind of look at. You rally, but there's not enough buyers to push you into the overbought region, which is why the August high was so unusual, to be honest with you. It was certainly an outlier from other rallies in 2022. But overall, this most recent rally, I think, is questionable in terms of the longevity of that rally, given the fact that the momentum stalled out where bear market rallies tend to stall out. So overall, when the market is below two downward sloping moving averages, when we're failing to get above key Fibonacci levels, I would not hesitate to label this a bear market overall, and a bear market rally when you get some sort of upward moves like that. I think the action we're seeing today is just a risk-off day, but again, it's not about today. This is more about the longer-term trend, and again, thinking about the short term, which we've been talking about, versus the medium term and the long term. I would argue still very clearly in a distribution phase. Now, we can also look at sector movements today. I just want to highlight very quickly the best performing sector, still down 0.8%. Utilities, REITs, healthcare, staples, all down around 1% or a little bit less than that. The sector is leading the way lower today. Energy down almost 5% today on the XLE. And again, a lot of those names overall still very constructive. Those are coming off of new all-time highs, are very close to that. So let's keep that in mind here. Consumer discretionary, second from the bottom, down 3%. Technology down 2.6%. So it's worth noting some of these, high-flying sectors, some of these sectors that, I arguably should be leading in a bull market phase, very much not leading today. And you're seeing some weakness, in particular the consumer discretionary ETF, the XLY, making a new 2-year low today, right? When you're thinking of, what would I need to see to be bullish, the XLY making a new low is not one of those items, right? That is not on my all things are good sort of a list. That is on the panic and get in a fetal position and get defensive sort of list. This is one of those, the XLY making a new multi-year low. That's something to be avoided. That's not something to be bullish when that's happening. Now, why is that happening? Why is the XLY so weak? Now, you have to remember the XLY is heavily weighted to 3 stocks. Amazon, Tesla, Home Depot, and those 3 stocks together make up about 45 or 50% of the weighting in the XLY. They are big mega cap names that have an outsized impact on the XLY. If you look at the chart of Amazon, obviously making a new 52-week low today, we're below 90 for the first time in a number of years. If we go back about 5 years, I will tell you, back here in 2018, back here in 2020, coming out of the COVID lows, right? When you're in April, May of 2020, and while the S&P is still nowhere near its February peak, what causes you to be bullish in that environment? I would argue it's when stocks like Amazon are making new 52-week highs, right? When Amazon has now broken out of an 18-month base and is making new highs and is accelerating to the upside above two upward sloping moving averages. Even though the S&P's chart, I would argue, still was questionable in terms of its overall trend. It's undeniable that there's strength in the market in the fact that Amazon is making a new 52-week high. So I would say in mid 2020, I would be hard pressed to be bearish when Amazon, a key stock, is doing so well. Flip that over, and I think that's why you would be hard pressed, or I think I would question the idea of being overtly bullish when Amazon is making a new multi-year low. The same argument that we made in 2020 is the opposite argument of what you should be making here, right? How bullish do you want to be on the equity markets when Amazon is making a new 2-year low? And my answer would be not much, right? I think that is all the evidence you need to be fairly defensive. Now, you have to remember we're oversold here. Look at previous times when Amazon's oversold. Have we had a bounce? Often we have, absolutely 100%, not 100% of the time, but many times we have. Having said that, in extended bear market phases, you'll have oversold conditions. You'll bounce a little bit, but then you continue lower. And it's all about the recovery after that oversold condition that tells you, I think, a lot about what you might need to know about what may come next. That's it for the market recap. Let's take a quick break and we'll be back with the next segment, the bottom line. We'll see you in a minute.
StockCharts.com. Members gain access to our most powerful tools, features, and resources. Discover the full functionality of the StockCharts platform. Monitor and analyze your portfolios and find promising new trading or investment opportunities faster. Whether you're watching the broader markets or tracking an individual stock, our unique range of charting tools and analysis resources will give you the edge you need to stay ahead of the curve. Begin charting like a true market pro. Join now to explore all the benefits of membership.
Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before we move on with our next segment. First off, we welcome your questions. We'll do a mailbag segment on Friday's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We are on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have such fantastic content from an impressive group of contributors. People like Larry Williams, Martin Pring, Bruce Frazier, Tom Bowley, many others providing commentary every trading day. All available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Our next segment is the bottom line. What we want to do is focus on earnings, right? Earnings are always going on, particularly in certain sectors like consumer discretionary tends to have earnings spread over the quarter. A lot of companies will be focused in on a couple weeks, which we call earnings season. And as we wrap up this earnings season, I wanted to highlight some of the names reporting this week. Just look at what happened going into the earnings announcement, what happened coming out of the earnings announcement, see what sort of takeaways that we can draw out of that. Now, today in particular, we had 3 names before the open. I just want to walk through those very quickly. And to be clear, I haven't looked at some of these before the show, so we'll look at them real time and sort of do some analysis. Roblox, I know deeply because my son is always, my 6-year-old son is always begging me to play some new Roblox game with him that he found. I have caved in occasionally. It's an impressive platform, particularly the microtransactions, which are just beautifully incorporated into the dynamic where you're able to continue to upgrade what you're doing by spending Robux, which translate into real dollars for mommy and daddy, as I try to remind my son. However, the chart of Roblox, what are we doing? Here's the thing. If you look at what happened in October, we had a nice bounce off of support around 33.34. From mid-October, we rallied. We got above the 200-day moving average here in mid-October for the first time since January of this year. So quite a nice recovery. But here's the thing. What's the real measure of success for Roblox? For Roblox, it would be getting above $50 a share. And the reason why I say that is because that's the peak in March. That lines up with the peak in August. Getting above there would potentially complete this sort of cup and handle like pattern. It's not an ideal pattern, but certainly a basing pattern, right? A bottoming pattern of some sort. Getting above that resistance would really change the character of this chart. And I was encouraged with the idea of doing so, particularly after we bounced off of 35 a number of times. Today, though, a miss on earnings, the stock gap's lower and closes below that level of support. So in my opinion, this is now a chart in a distribution phase. Just getting to the oversold region today, that doesn't mean the downtrend is over. That just means the stock has gone down a lot. This certainly has a risk-off feel to it, down quite a bit today, right over 20%. This is a big gap lower. Things like that usually don't just end on a dime and rip higher the in the coming days. This is often more the beginning of something that evolves over time. So I'm immediately looking further down on the chart. $25 would take us down to the June lows. I think that could be a potential downside target for a key name there. Canopy Growth CGC is a cannabis name. They reported before the open here today as well. It's a small cap stock, so it's only $1.5 billion. And the reason why I don't talk about a lot of small cap names, but CGC is one of the few U.S. listed or companies listed in the U.S. with an explicit cannabis focus, right? So it's not a sort of tangential play on the cannabis industry, but more of a direct play on what could happen here. What's encouraging on this chart is the fact that we have found clear support. The lows in July around $2 a share lines up with the lows in October around that same amount. Bouncing around a little bit, and a nice day overall is holding up today on earnings, up 0.3%, while the major average is down 2%. So that's worth noting. But what would I need to see? I'd certainly want to see it rotate above the previous highs, right? Getting above the August high would be meaningful. Getting above the 200-day moving average for the first time since last May would be encouraging as well. And on a stock like this, you really need to get above $5 a share. That's where institutions can start to participate a little more often. If you look at the RSI has not really been above 60 in any meaningful way since the beginning of 2021. That's a year and a half plus ago. It's almost 2 years ago. So the RSI remaining below 60 is characteristic of a bear market phase, which is exactly how I would describe this trend. So we have found support. We stopped making lower lows. That's encouraging. That low holding would be incredibly important. Can we break above an RSI of 60? Can we break above the previous swing high? Can we get above the 200-day? Can we get above $5 a share? All those things happen. I think this has a chance to move materially higher, but you got to do those things first. DHI is the last one we'll have time for today. It's an encouraging chart, to be honest with you. Anytime the market's down 2%, you have a stock that's up 3%. That tells you something. So on a day like this, it's always important, I think, to look at the big gainers list, right? Look at the names that are up on a down day. That tells you that there might be something there. Look at the chart of DHI, and again, just like we talked with the S&P 500, take a step back from this chart, and I would argue it's a little more of an accumulative phase, right? It's showing you that buyers are coming in. We had a low in June just below $60 a share. We've now made a higher low around 66 in September and October. We're now rotated above the 200-day moving average for the first time since January. We're threatening a new swing high, and that's why $80 a share, I would argue, pretty important. RSI stalled out at 60 on this last rally at the end of October. We rotate above $80, get above that base. Relative strength makes a new multi-month high. That could be an impressive chart rotating higher. Home builders are an interesting space to look at for sure. And a nice higher low in October. I think that's the most encouraging sign on this chart. A number of names reporting after the close, including Rivian and Wynn, and I would encourage you to take a look at those in the morning, see what happened with earnings, and make sure you're prepared for most likely a volatile day ahead. Our next segment is called Banking on Breadth. What we like to do midweek is check in on some of the major breadth indicators, see what lessons and insights we can derive from them. And let's get to the charts here. We'll start with the S&P 500 breadth by cap tiers. Here's the S&P 500 at the top, and then we have the advanced decline lines for the New York Stock Exchange. Large caps, mid caps, small caps. These are not quite updated for today's close just yet. So look for these to probably downtick given what we saw in the markets today. Once we update all the data here in the coming stretch. after the close as we digest all the closing data. All four of these, as of yesterday's close, above their 50-day moving average. That's why I color-coded them all sort of a neutral orange color. They're all coming off of a new 52-week low in the last 6 to 8 weeks. So overall, I would argue these are neutral. They get back below the 50-day moving average, I'd have to consider them more negative once again. I'd need to see them break to a new swing high to consider those to be more confirming positive, which for me means I'd want to see them get above the August high, which means overall, at best, I would say these are neutral. At worst, these are rallying off of a new low, and the trend of new lows is certainly the most concerning trend I'm seeing. The new low for the S&P in September was confirmed by new lows from all of these four indexes. At this point, the S&P back below its 50-day. Want to see if these breadth indicators also get below that key level of trend analysis. When we look at the stocks above their key moving averages, arguably more neutral than anything, mixed, I guess, right? If you look, 38% of the S&P 500 members are above their 200-day moving average. That's about 1 in 3. The S&P 500, obviously well below its own 200-day moving average, which is around 40.84. So obviously we're all below that at 37.48 today at the close. So 1 in 3 S&P names above the 200-day, I have this horizontal line around 50%, because what I've found as a very basic measure of trend analysis is when something is above its 200-day moving average, that's a basic definition of an uptrend. If it's below the 200-day moving average, that's a downtrend. Overall, that pretty much maps to what you would see looking at long-term charts over many, many years. This breadth indicator, I think of it the same way. If it's above 50%, that tells you over half of the members of that index are above their 200-day moving average. That's bullish. If we're below 50%, that's bearish. We went bearish back here in February. We've sort of chopped around for a little bit and then have remained below that 50% line that entire time. We noticeably peaked out right at 50% there in August, which is where the S&P peaked right at its 200-day. Talk about a beautiful signal indicating an exhaustion of buyers going right into that key level of resistance. Here's the opposite side of the coin, though. Over half of the S&P members are above their 50-day. The S&P just closed back below its 50-day today. As of yesterday's close, though, and actually, I think this is updated for today's close, 60% of the S&P still above their 50-day moving average. So over half of the S&P actually hanging in there okay. Look to see if that's able to hold 50%. As you see the distribution today, as we go through Thursday and Friday, and you're wondering what this week teaches you about the overall trend, this might be an important chart to watch. This remains above 50%. Overall, markets are hanging in there okay. This gets below 50%, I would argue, this might be a bit of a concern. Our next chart, bullish percent index, and here's the S&P 500's bullish percent index. Again, this is an indicator based on point and figure charts, and this is looking at the percent of point and figure charts in this bucket in the S&P 500 that are currently in a buy signal, or most recently in a buy signal. If you look at the chart, it's currently around 62%. If you think about what that means 2 in 3 about S&P 500 names are in a bullish point and figure chart. That's encouraging. It's above 50%. That's overall pretty good. The real message on this indicator is when you get to the extremes, from my experience. When you get above 70%, you look to see when it rotates back below. When it gets below 30%, look to see when it rotates back above. One of the best signals in 2022, going back to November of last year, to be honest, has been when these bullish percent readings have gone above 70%. When that has happened, that has often been the end of a meaningful bear market rally. It's worth noting, and on this rally from mid-October to the end of October, we never got up to that point, which is what tells me, one of the things that tells me this really wasn't a meaningful bear market rally, although it certainly felt like it, as stocks are rallying so beautifully out of the lows in mid-October. Overall, this isn't even, tipping the needle to the bullish signal, which would be above 70% of this indicator. It's worth noting there. The NASDAQ one we'll look at here in a second. You'll see it looks a little bit different. So overall, what would I be looking for here? If we continue to rotate lower, go below 50%, that would confirm we're very much once again back in a downtrend. So how do I differentiate what's happened now? Because now, if you look back for the last 2 months, last 6 to 8 weeks really haven't gone anywhere. It's sort of been a choppy sideways pattern. Look to see where this goes next. Does it go above 70% or below 50%? That might tell you what you need to know about the immediate next move in the S&P. Now, the NASDAQ's version of this, worth noting, just got barely to 70%, but didn't quite get above there. It's worth noting both of these, with the S&P and the NASDAQ, didn't get above that basic definition, according to the Bullish Percent Index, of a confirmed bullish trend. It never triggered. So what that tells me is overall, this is still a chart in a position of weakness, and I would be concerned about the potential of that market to go higher. Finally, just to finish off, and I have to wrap the show, it's thinking about volume. When I think about volume, I think of it in a number of different measures, and one of them is looking at the trend in volume. Now, there are different ways to look at the trend in volume over time. One of the ways, this is something that Joe Granville created years ago, was on-balance volume, which is basically taking the daily volume reading and aggregating that over time, looking at the direction of the close, one close to the next, as a way of measuring it. Look at how this on-balance volume has been trending downwards through the course of 2022. When people are getting excited about a rally in stocks and I see the on-balance volume making a new low, that is not an encouraging sign, right? The S&P making higher lows, but the on-balance volume making new lows is not encouraging. The on-balance volume is a better measure of volume related to the trend. It's not just looking at the price, it's looking at the volume behind those days. And all of these big days in red are down days on heavier volume. That is what's driving that OBV value down and to the right. That is the sign of a market in a bear phase. So overall, I still see this market big picture in a pattern of distribution. Today was one day, but overall, I'm seeing signs of weakness as I go through some of these breadth indicators. Folks, we need to wrap the show and go right to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1 in our segment on our market recap. Actually, we're talking about Amazon. And I will tell you what I mentioned in 2020 was, how bearish do you want to be when Amazon is making a new 52-week high? Today, I flipped that quote around, or that question around, and I ask you, how bullish do you want to be when Amazon is making a new 52-week low? Now, is Amazon the market? Of course not. Are there stocks that are coming off of new 52-week highs? Absolutely. Are there charts that look constructive, that even if the market is in a pattern of distribution, the charts are still okay? 100% true. But overall, Amazon making a new 52-week low, it's kind of like semiconductors making a new low, or Microsoft or Apple, or one of those big mega cap bellwether names. I would say a bull market in stocks most likely involves charts like Amazon looking a lot better than this. So I would hesitate to get too constructive until you see buyers willing to take a chance on a very stable, arguably company with good earnings potential down the road, like Amazon. Amazon, again, down over 4% today, double the negative move in the S&P 500, and making a new 52-week low. Chart number 2 is the percent of stocks above key moving averages. While I would argue that the average stock is looking is struggling here, and certainly the mega cap growth stocks are struggling, still 60% of the S&P members are above their 50-day moving average. That tells me that while the overall conditions are weak, while the major indexes are certainly struggling, there could certainly be opportunities out there. And it's all about finding those opportunities by scanning for stocks in good technical configurations. Finally, and again, I'm just coming back from a week, 9 days actually, in India, and it was such a pleasure to meet many of you. I look forward to talking more about Indian indexes and exchanges and markets when appropriate on this show and elsewhere on StockCharts TV. We have a lot of ideas on how to expand our coverage of this broad and growing market. But I would notice, if you're looking for strength globally, and if you're looking for something that is not highly correlated to the US at the moment, India might be it. The INDA, which is a pretty liquid ETF, does not look nearly as positive as the Nifty, $ Nifty, very close to making a new high. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.